Welcome everyone. Welcome to those joining us from all around today. I'll just give attendees and participants just a few minutes to, a couple of minutes to join us, and then we'll dive into this webinar, of course, on the off-grid solar investment trends from last year to get a sense of what the industry investment is doing. And we also have delighted that we have a couple of expert panelists to also share some thoughts with us today. But we'll just give people a couple of minutes to join, and then we'll kick off. Fabulous. Let me jump in, and I'll take us through these introductory slides, and I'm sure more people will be joining as we go through. But again, welcome to everybody. My name's Susie Wielden. I'm the head of communications and insights at GOGLA, and we're very delighted to welcome you to our webinar today on the off-grid solar investment trends for 2022. We just want to extend a big thank you to GET.invest for supporting our work on this and helping us to gather the insights from across the sector, investors and companies, and also to all of the investors and companies that have supported us with this work as well. It's a shared effort, and it's a benefit for the sector. And so, as I mentioned, my name's Susie Wielden. I'm also going to be joined on this call by Laura Fortes, our Senior Manager for Access to Finance, who's going to be taking us through some of the investments as we see them and all of the data into the session. And taking a look at that agenda, that first section will be on those investment trends, or the big themes and the big data that we're seeing, as well as some of Laura's reflections and thoughts, having spoken to a number of investors and companies in our space. And then we'll also be delighted to hear from Coolbox and Nithio, who are going to share some of their perspectives on the investment in the sector today. And we'll also then go to some questions and answers after that. Look, I think it's just the next slide on from here. So this one's a bit of a call for action. Please do share your thoughts in the chat. If you have a particular person that you'd like to address your question to, please pop their name in there. And then, yes, at the end of the session, we'll have hopefully 20 minutes or so to go through some of those Q&A and for you to have your say. So without further ado, I will hand over to Laura, our Senior Manager for Access to Finance here at GOGLA, and she's going to start running us through our big numbers. Over to you, Laura.
Thank you so much, Susie, and thanks everybody for joining. Once again, today I'll be presenting investment data of 2022 for the sector. I hope that some of you have seen, we have already put out communications around it, but yeah, we wanted to have a chance to interact, respond to any questions, and reflect on this data more publicly on this webinar. So here we have a slide around the historical data so that you have a bit of context into how much investment has come in the space before we dive into the 2022 numbers. So we do track data since 2012. So it's data from the past 10 years of the sector. In that time, we have tracked that the sector has received a total amount of 3.12 billion in terms of investment commitments. We have more than 1,000 deals tracked, 190 number lead investors for each transaction. And we have tracked 219 total number of fund recipients from either off-grid solar sectors, service providers, and productive use companies as well. On the next slide, we're going to see headline data for 2022. So this year has been really a record year We have jumped from around 470 last year million to 746 million, which is quite a big jump in investment commitments. We have tracked 149 deals and that have been backed by 53 lead investors and 58 fund recipients. And here you can see how much the sector has grown since 2012. So yeah, what we have been seeing, it's a young sector for the first few years, attracting very minimum investments until a big jump from 2015 to 2020, where we saw investments really reaching a height and not really growing. And in the past 2 years, we have seen growth, but that has been mainly driven by companies that are in the scale-up phase. And I'll explain who those are and how we classified companies in the next slides. So yeah, like I said, we have hit an all-time high, but this growth has been really driven by the scale-ups. What we track as seed and startup funding, we are seeing it's remaining relatively stable compared to the scale-ups. Then the bad news is that equity that's been earmarked for startups is decreasing, specifically this year. It has decreased around 40% with respect to 2021. So that's something that we really want to look into and work together as an industry to see how we can increase those numbers. And the headline data of 2022, we attracted 395 in equity, 314 in debt, and 11 million in grants, with equity for the first time in, I think, around 4 years being higher than the debt attracted by the industry. And then here, this is just a slide to clarify how we classify companies in our database. So we have classified companies that have attracted more than 100 million in total funding, including equity, debts, and grants as scale-ups. And there are 7 companies on that stage. There are 43 companies that have attracted from 3 to 100 million in total funding. And then there are, historically, we did track 160 companies that have attracted funding from 0 to 3 million. So that's how we're classifying companies, and that's where you're going to see in the next slides that analysis separated in or broke down into scale-up, startups, and seeds. So to clarify and see how each of these segments is evolving. Yeah, so this slide reflects a little bit sort of like the order of magnitude in terms of investment attraction in each of the stages. So if you look at the scale-up stage, then you'll see sort of like the growth and how that compares in total investment attracted to startups and that have received around 100 million in the past 2 years, and then to seed companies that are really on a stage that is really early and have received way less compared to the order of magnitude of the scale up. So this is just a graph to understand like how each is in terms of order of magnitude. And then we're going to go to slides that are going to analyze each separately. So here we have put up scale-up investment trends. So what you're going to see in the past 5 years that we see, especially from 2020 to this year, investments that are earmarked for scale-ups really growing. And then specifically this year, there's a massive increase in 2022. And that increase, if you take a look, has been mainly driven by equity funding. Though if we are going to look closely at the data, I mean, we have to know, in the next slide, we have a bit of analysis on that this massive equity jump has been mainly driven by the good news from Sun King doing their big equity raise. If you go to the next slides, book. yeah, so from this total amount of investment, 106 have been attracted by the scale-up companies. You have here on the right who those big seven are. There are 5 companies from these that we tracked that have raised this year. But yeah, like I said, most of the big increase in equity has been driven by the Sankings deal. Attraction of debt has remained around the same level. Grant funding is really not significant, though I have to say that the database tracks venture-based grants and not RBF, which is being tracked separately. One thing also to clarify, we see the industry really diversifying into other segments. And for the deals that we see that are not earmarked for energy access, we do not include it in this database. So there have been specific deals that have been announced in the industry where we see that it's mostly sort of like assigned to more commercial customer segments that are not included here in the database. And here we see startup investment trends. So here under you also see the number of companies that are attracting, say, investments per year. So we see that this year we have tracked 18 companies that have done a deal, a debt or an equity deal mainly. And then, as I said in the beginning, what we see as a little bit more concerning is this decrease in equity that's really decreasing around 40% this year. That's being replaced by debt in the industry. And in the next slide, we have a bit more analysis to support what we mean by this. So yeah, out of the 43 companies that we mentioned in the beginning, 18 received investment, and that has increased by 50%. One thing to note here is that 11 million of that has been earmarked as relief funding. So just to highlight that. So yeah, startup companies' total amount of investments have increased, but then a little minimally, so just 9% compared to 2021. And the total funding levels have not reached pre-pandemic levels yet. So there's a lot of work to do in this segment. And this is for the seed companies. This is a little bit like more, it's less, a little bit more difficult to interpret the trends here. We see a decrease in grant funding, which is the main funding companies going through the capital continuum. So these companies do access a lot of times grants first. We see a decrease there, but then I have to say that there was an amount of the deals that were anonymized and we could not track or assign to any of the companies. So it is likely that the investment towards seed companies is more or less similar to last year because we're missing a big chunk of the grant funding that could not be assigned to a specific company. So you'll see that the total amount of grants attracted does not really match with what we have been able to assign, and that's because of a few grant funding deals. And then a little bit of a similar trend around the equity that we do see as a little bit concerning, since we would like for companies to be able to attract more of it. Also the number of companies with respect to the previous 2 years has decreased a bit. And that's also related to grant funding programs being sort of like cyclical, and a few grants makers have not been making so many deals this year and will make deals next year. Yeah, so I think we can move to the next slide. Yeah, so we wanted to highlight here a few other trends. We are tracking for the first time and doing division in terms of African-owned companies. So from the total 81 million where tagged as companies that are African owned. One thing to note here is 9.8 million of these were grants, and I'm putting this because the total number of grants were 11. So what we see is that there's a little bit more of a donor or grant making program focus in funding African-owned companies. 32 million was earmarked as productive use companies. This is the second year where we make this division. So this is a 20% increase with respect to this year, which is a good increase, but coming from a low baseline. And then where we can do a lot better is in funding going towards female-led companies. This being defined as companies that are more than 50% is ownership female or female managed. So it's a little bit of a higher baseline than the 2x 30%. Point on subsidies. This is out. So the number that you see here is a historical number. So we have tracked that the sector has received, well, has 312 million of RBS have been committed or were already disbursing until last year. And that's quite far off where we need to be in terms of total subsidies needed for the sector. In our last Outlook report, we calculated that 4.5 billion were needed only to address the affordability gap. So we're also a little bit far from that. A little bit is a lot far. And yeah, here just a slide to on a few conclusions, and we have been working quite a bit. We have different finance and investment working groups being formed to analyze how the sector is and how we can do better. So a few conclusions here. What we see is that market leaders, the success is really a positive signal to attract further investment and further equity. So the fact that Sunking has been able to do such a massive equity raise and their success is something to show in terms of that, you know, the sector can balance impact and scale together. So that's really good news for the sector. However, one of the things that we see as well is that for the first time in quite some years, the number of people without access is increasing, and subsidies will be needed. We presented that number in the Outlook report in terms of subsidies, but yeah, we need subsidies to reach markets that are underserved and to reach consumers that cannot be reached. One of the things that we see as well is that companies that are now in that startup stage are focusing more on unit economic sustainability and performance versus scaling rapidly. And that's something that we see also mirrors current global trends with the multiple crises that we are facing. Investors have a sharper focus on that. And then the companies that we see succeeding more are also have that focus. One of the things that we're really working on at GOGLA is to sort of like work on the narrative of the sector and present that we are a climate investment, which we are. We see as well that the global conversation is moving towards a little bit more like from mitigation to adaptation and resilience. And we see the sector as an adaptation and as a climate resilience and adaptation tool. So that's something that we're working on, and that, you know, we see a lot of companies also, you know, going into that narrative and attracting that type of investor. So there's an interesting new pool of capital there that can be attracted that, you know, we should be focusing more on. And then overall, we need new and improved finance instruments that do blend concessional and commercial capital that match the cash flow and returns of companies. We're looking into how to monetize the sector's impact. So we're looking at things like carbon finance, which are minimal, but then how can we make sure that the positive socioeconomic benefits from the sector are being monetized? And we need to attract new pools of capital to the sector, because if you look at what we need, where we are versus where we need to be, there's there's a big gap there. So we're really working on that. We have very good allies in the sector, committed investors. So at GOGLA, we're trying to work on this. And in the next slide, just to present one of the things that we're doing, we have launched a finance and investment working group that Sarah Bieber from Acumen is chairing. And then we have identified these 4 task forces that are going to be working into how to think through how to attract more capital, how to make it more fitting to the sector. So we have a re-engineering that group, catalyzing early stage equity. We have a monetizing impact group, and we have a group around new pools of capital. It's for GOGLA members, but if you are a GOGLA member and are here and would be interested in joining, please do reach out. Also, if you have great ideas, regardless, I'll be very keen to hear them. But yeah, we're definitely really focusing and working on this. And then on the next slide, just to highlight, in case you are not aware, that we have an investment forum coming up. So Unlocking Solar Capital Africa, this is the 5th edition, and it's really our investment event. The event goes beyond off-grid solar and productive use. So if you go to the next slide, then in the program, we're highlighting cross-cutting topics between utility scale, C&I, mini grids, productive use, weak grid, etc. So if you want to take a look at the program and keep on discussing these issues, then you're very welcome to join us there.
Fabulous. Thank you so much for taking us through. I'm hoping you guys can hear me. I apologize. I had a little audio problem there, and I'm now on 2 screens. So again, apologies if I'm looking away a little bit as I do this, but I would love to now introduce Roland Menger, the Head of Capital and Investor Relations at Nithio. So Nithio is a long-standing investor into the off-grid solar sector with a particular focus on energy access and climate. And they have really robust and strong foundations in AI and analytics that are helping to guide their investment strategies. And delighted to have you here today, and welcome, Roland. So to kick off, great. To kick off with a very broad question, as an investor in our space, how do you see the investment landscape? How do you see its evolution? And thinking about some of the trends that Laura shared, particularly around obviously the differences you might be seeing between the scale-ups and the startups, what are your reflections in terms of some of the challenges and opportunities?
Yeah, it's a good question. And these data points are very useful to start thinking about the sector as a whole, because often you look at the sector, you see things happening and you start analyzing why, and having this data really helps out just to make thoughtful decisions. So as a background, I've been at the operator side. I did corporate finance for Zola Electric. I've been on the equity investment side for EDF, where I did the equity investments for on behalf of the French utility. And now I'm here at Nithio. So reflecting on the sector as a whole, since I've been active in it for quite a while, I've seen first a shift where we started in what I call a low margin, high volume business that resulted somewhat in a kind of a land grab where market growth, portfolio growth was everything. And then before COVID, we had this, we came to this point where actually credit became the most important metric for future investors because it was growth above all. So now actually that both this growth and this credit have been stabilizing, and then mainly for the scale up, so really the larger, the top 7 companies, you see that the business is maturing, and you actually see that there's a big gap opening up. And what I mean with that is a gap from those 7 companies towards the middle companies. So I call them tier 1, tier 2, tier 3. So the middle income, the middle companies, which are regionally located, regionally driving business, are still in hyper growth phase. And the tier 3 locally owned businesses, locally owned distributors in just their own home country, right? And so what I've seen lately is that actually equity is drying up for especially these last 2 categories. And that is because in general, there has been a kind of a merger and acquisition phase where the larger companies keep on growing, maturing their business on this lower margin, higher volume business, integrating and having synergies on that level. But the companies that are being bought are not necessarily the best exits for the equity providers in there, right? So equity providers in this like startup and even like further down the road, seed companies do not see a path to a successful exit. Then secondly, if you are in this atmosphere where you're still in hyper growth mode, you are losing money. You're not being cash flow positive. And I'm generalizing here, right? But not being cash flow positive, you're focusing on other metrics and you're focusing on your growth. But so if equity dries up, what happens? Each year you have negative income going into your like a negative cash, going into your negative cash balance, negative equity, into your retained equity, meaning eating away your equity position. So if no new equity comes in, your equity position becomes lower, meaning on your balance sheet, your leverage increases. With that, I mean your debt towards total assets increases by a lot. So if equity dries up now, it means that debt will dry up in a couple of years down the line, because as a company is over-levered, nobody will invest debt in it anymore. This is something that's striking me as something that we need to discuss and urgently need to treat to see how this could be improved, right? So what I see as what I already see as a result, like this more M&A activity of the larger companies taking over the crunched middle is generally a good thing towards sustainability and profitability in the sector, but I'm not sure what the long-term effect will be on reaching our sustainable development goals in the end as fast as possible. And secondly, what I've seen is that to balance and counteract this higher leverage, increasing leverage by this negative equity situation, you see more and more companies looking at off-balance financing, meaning you're taking debt off the balance of the operating company, so to decrease the leverage there. And this is something that is very interesting and is really just starting to like catch on in the sector. In my experience so far, it has been very difficult. It's a very legally, operationally, and financially hard process to do and to follow. And as long as there's no sizable portfolio or some kind of form of standardization in terms of legal contracts, in terms of a standardized backup servicer, I think these structures will like still be very costly and risky. So also there is a role to investigate how we can make that work better and more standardized.
So for you, in terms of then how to resolve some of that challenge in terms of those startups and seed financing, mentioning there, of course, mergers and acquisitions, the off-balance sheet financing. Have you seen some examples of that are already beginning to pique your interest? And yeah, how do you place that in terms of the potential evolution of the sector?
Yeah, so what we at Nifio see as a huge opportunity is this local-owned, locally operating distributors. Those are very hard to identify because they're often small, meaning a small ticket size in terms both of debt and equity. You have a limited view on credit scoring. Sometimes these companies have a lack of a professional corporate finance team, not already automated ERP or PAYGO system. However, when you find these companies, you interact with them, as we are currently doing with Nifio, we see that these companies have very strong unit economics. They are in regions where nobody else is active. So often there's a premium on the revenue, they can charge more. They have more local knowledge of the environment, control of the sales team, effectively leading to a higher credit scoring, as we've witnessed. And secondly, being locally operated and owned, we definitely see a lower operational expenditure there. So these are companies that from like if you really look into them, have a very solid base of being investment worthy. But on the other hand, of course, how do you do that if you can only invest, let's say, in ticket size of 200,000 euros or dollars? So this is something that we are looking into, and these companies, they need to be supported with debt and equity in order for them to grow and in order for them to also become profitable for these deal economics that we are facing. So an example that I'm thinking of is Winox Solar, which is a Nigerian company doing solar home systems and productive use appliance in north of Nigeria. So we took, let's say, ballpark number 200K debt investment in that company. We connected them to Acumen. The company grew. Acumen invested equity in the company. On top of that, we invested more debt, and now you can see things are really starting to turn, and you can start investing $1 million. And so we're growing with such a company and evolve with it over time. And looking at their unit economics, their P&L. It's just worthwhile to find these investments, locate them, and take that bet on them. And I mean, honestly, Nithio is, I mean, we've got our AI tool, we automate lots, we do a lot of standardization, but still, like, I can tell you these very small deals, the unit economics don't make sense. However, if you can grow with them, unit economics will start to make sense. And that's where I hope more and more capital and a lot of hopefully patient capital can be directed towards.
So lots of opportunity if you're sort of thinking with that slightly longer term time horizon.
Yes.
Thanks so much, Roland. Okay, and just to remind people, you can start popping questions into the Q&A. I think that was the idea, ideally the Q&A box. So we will keep Roland with us. Don't worry, you'll have a chance to ask him some questions. But for now, I'm going to turn over to Natalie Casey, who's the Chief Business Officer at Coolbox. So thank you so much, Natalie, for joining us as well. Coolbox focused on solar refrigeration. They blasted onto the scene a few years back. And Natalie, yeah, I'd love to hear your experience as Coolbox in terms of some of the sort of evolution of funding in the space and the reflections that Laura and Roland have shared, and also maybe some of your direct experience in terms of investment in 2022.
Yeah, sure. Thank you for the invitation, Susie, and really happy to be here. So as you mentioned, Coolbox is still kind of early on the scene. We started commercialization of our first solution in the middle of 2020, in the middle of COVID. And then we finally started to first, again, as Laura mentioned earlier, having access to some grant funding before. So our trajectory has been pretty close to what was described earlier when we were reviewing some of the statistics. So over the course of 2021, we started to engage in our fundraising efforts. And so while the scope is to discuss what happened in 22, we finally closed in January of 2022. So much of that first experience in raising the seed round was related to the environment in 2021. What we quickly realized after raising funds in 2022, essentially, was that we had likely underestimated the market demand. And so now we are officially launching our fundraising for the Series A round. And we're facing some differences, I would say, for sure, related into the environment. And I think one of the key ones, which Laura also mentioned earlier, was around the focus on climate. So we do see a lot more interest, and in particular in the impact space related to climate solutions. So a lot of the conversations have been around that, in addition to some of the other impact areas that our company touches.
Fantastic. Really interesting to hear that, I guess, with refrigeration as well, both on that resilient side of things that Laura had mentioned in her slides, but also the mitigation where you're preserving food and avoiding emissions from food loss as well, which is a really exciting opportunity area, I guess, in terms of reducing those emissions as well. So great to see. And it sounds like that climate theme is coming through for you. But yeah, maybe to turn to sort of the future and how you think the evolution of investment is looking for Coolbox and perhaps other productive use companies as well. Are you able to share a bit more about how you're sort of thinking about your future of investment as you go through 2023 and into 24?
Sure. So it's true, the productive use space, it has become more present of late. I think that there have been some cycles related to the access to energy companies. And now it's maybe the time for now these productive use appliances. And what I see that is maybe a key difference is that because they are productive use, for productive use, then there seems to be different unit economics, always an important question. And in particular, we see that because the assets are income generating, that the repayments for the PAYGO, the appliances on PAYGO tend to have pretty favorable repayment rates. And so that is then feeding into the positive unit economics for the company. And then also in turn, making the Coolbox investment a more attractive opportunity. At least this is the feedback that we've heard.
Fantastic. Great. Super exciting to hear. I guess one last quick question, because Lara did tell me that you're going to be joining the Unlocking Solar Capital in Africa and shared very briefly some of the program. Yeah, just interested in your perspective of the kinds of themes and trends you're hoping to dig into at the conference and the different sort of activities you hope to engage with. Yeah,
absolutely. I think first and foremost, it's the face-to-face contacts. Since we are in fundraising mode, always a benefit to be able to meet different stakeholders in person. So certainly looking forward to that element, as well as the conversations around Series A, because we're in full fundraising mode. One of the key strategies for the company as part of the Series A investment will be market expansion. And so while we have established a footprint in Nigeria and now have grown since starting our operations in Nigeria to 125 employees on the ground, now we're looking at opportunities in other key countries, and Uganda, through our market research, is presenting as one of the key markets where we see opportunities for expansion. So very much looking forward to learning more about the market and meeting with other players in the space there.
Fabulous, fabulous. Nice to hear that Uganda's a top location for you as well. Great. In that case, thank you so much, Natalie. I'm going to move to some Q&A, and I apologize because I will probably have to. My screen is going so slowly. I'm going to have to double screen on this one to see if we've got some questions coming through. None yet in the Q&A. Any in the chat hiding? None in the chat hiding yet. Just obviously, please start popping questions you might have for Laura or for our panelists. Also, we have Salome Ndida, who's also joining from Nethio side. She's a colleague of Roland's, focused on, she's an investor associate from East Africa and very much interacting with companies, and so can bring in additional lens into her experiences here. So welcome, Salome. Let's see if we have a few into the chat. If not, I'm going to sneak in with a kickstarting one. Let me just flick between the two. None in Q&A, any in chat for the moment. In that case, maybe I can kick off the Q&A and ask a little bit in terms of solutions. So we heard a little bit from Roland in terms of some of the things that he was thinking about in terms of how we can bring some more equity, early stage equity into the sector, or create some more financing for early stage companies. Just really interested in maybe sort of hearing from everyone in the group about the types of financing innovations and the solutions that you think that we need as a sector. We have this huge access gap in terms of 730 million people without electrification at this point. We have more with insufficient grid. We have huge numbers as well who don't have access to efficient appliances and those kinds of tools. Just, yeah, interested in your perspectives, and maybe, Salome, to pop you on the spot, if you could share a little bit more about the kind of the solutions that you're thinking would be helpful in terms of uplifting companies so that they can help to achieve some of these goals.
Great, thank you, Susie, for the introduction. And great question. So one of the general thoughts that I'd have in terms of enabling startups in terms of financing, as Roland earlier mentioned, indeed, we do need blended finance, which can catalyze the growth within these startups. One of the things that I've could also think of in terms of innovative financing is to consider a very nascent sector within Africa, but it is there, which is MES financing. And this would kind of address both from a leverage perspective as well as an equity perspective, given the fact that such instruments could actually sit as part of equity and however still have characteristics of debt, therefore bringing or mitigating some of the downsides of pure equity. And such an idea for kind of investors to think in terms of also getting in grant funding could be interesting in catalyzing further debt and equity raises in the future. One other thing that I feel I have seen some of the companies work with is to diversify their revenue streams. So you'd find solar home systems that's primarily doing solar home systems, but when they have engagements with people from the carbon credits, then they just have access to slightly more revenue, given the fact that their products can earn carbon credits. And this again is something they can use to create comfort for incoming kind of investors and give them also kind of returns through the carbon markets. And this could be catalytic in terms of increasing the amount of capital that we see inflowing to startups.
Fabulous. So some new innovations and some more carbon finance and climate finance coming in. Natalie, maybe to you in terms of sort of your perspective on the kinds of mechanisms and initiatives that might really try help to really scale and accelerate things at a more rapid pace.
Yes, I thought the conversation around off-balance sheet financing was quite interesting because what we see is that we've done our projections, we have an understanding of what the cash requirements will be. We'll be raising some equity in a way as well to be able to access the debt market. And there's always the concern around leverage and taking on too much debt. And so the way that we're thinking about it as a company is that, yes, we would want to be able to access the debt market, but perhaps the full cash requirement we would then seek in other ways. So either through off-balance sheet financing, it could be with securitization, it could be as well with working with local commercial banks, or really looking for grant funding to take some of that burden of leverage or the risks associated from the company at this stage.
Fabulous, interesting note indeed in terms of that local finance as well. Turning to you then, Roland, again, I know you've shared a little on this before, but maybe to expand or to dig into some of the perhaps examples that you've seen where you've really seen things moving in a positive direction around some of these sort of financial mechanisms.
Yeah, sure. So there have been, so in terms of off balance, there have been lots of proposals. Some worked better than others that I've seen so far. I mean, you've got a skill, right? I think Santander was the first, or one of the first, looking into what they called SAFI, their SAFI structure, structured asset finance. So it was an SPV, which you ring fence the receivables and you loan against it at SPV level. So it's off balance debt, but it's highly dependent on how the operator is still performing. Others copied this, others did some variation on it. And that's definitely a step in the right direction. It made things standardized, especially Santander did that quite well. Standardized, every SAFI was the same structure, so copy paste. To talk about like real securitization, like really structured finance, offshore, off balance, either lending against those or one step further where you're actually buying the receivables at a discounted value of their face value from the operator. So completely separate, no debt involved. That is something that we've tried before when I was at different companies, not with Nifio, and that wasn't always a very big success because it was new, it was novel. There's this huge risk of the underlying operator and borrower. Because buying receivables out of somebody's loan book seems simple and seems bankruptcy remote, right? But what if the operator goes bankrupt? Then somebody else needs to step in to still service those receivables, otherwise the cash will not come in. Well, these are things that we have been thinking about a lot, and this is something where the sector could greatly benefit of like a standardized approach. I mean, we've seen standardized approach in terms of PAYGO, in terms of like the PAYGO systems, the ERP systems, the data systems. PayGops is doing a great job amongst others on these kind of standardization, like off-the-shelf tools that you can use as a local enterprise or a regional enterprise to still unlock all these major benefits. I think we should take that one step further and start thinking about like one backup servicer entity that can value the receivables using Nifio's AI, has a lot of presence in many countries, so can actually be on the ground to service those, have a call center, blah, blah, blah. I mean, I see a huge opportunity in the market to set something like that up. Because if that's in place, and that could be as easily tapped into as a PAYGO system that PAYGO is offering, or as easily as when I would be a local entrepreneur in, I don't know, in Burundi, I can take out some Greenlight Planet or D-Light systems and I can start my business. So with all these things, with all this standardization coming in, you will have like huge growth opportunities for local businesses that be standardized, and huge growth opportunities for the really big businesses, because at that moment they can really start thinking about true sectorization, buying the receivables, taking them off balance sheet, even listing them in a Luxembourg bond or whatever with a diversified portfolio. So collaboration and standardization will be very important in this.
Great, thank you so much. I'm just going to quickly check. I still see no questions. My goodness, we have a quiet but still with us group today, which I'm super excited about. In which case, maybe I can just ask one last question to everyone on the group. I think you mentioning there, so I mean the climate finance, financial innovations, Natalie, the local financing, yourself, Roland, the securitization and the standardization that's needed for that. And sort of various things that we recognize on the investment side of things. Just interested as well in terms of maybe what companies can be doing to improve their investment readiness. I think probably linked to that standardization piece. But Salome, maybe if you could share insights into that.
Great. So I think there's a lot that young companies can do to enable themselves to be investor ready. And one of the key things, as Roland mentioned about standardization, is to better understand the key matrix, perhaps even using the GOGLA standards that you've kind of released in how they prepare their financial kind of statements or their dashboards. And this would really assist, let's say, us on the investor side in terms of quickly screening and even having feedback of this and this certain requirements need to be arrived at before we can continue with our conversation. Therefore, not leaving any company in particular in the dark and saying, well, why didn't I get funding? But rather understanding the gaps that they may have and address them, and then come back to continue that conversation. And if there is such a kind of clarity in what they're expected to put together, and also getting that investor feedback so that they know they're 80% ready and they need to do certain things to get to 100%, then it will create an ecosystem of faster investment processes, as well as the company themselves understanding what exactly they're missing and can easily address it.
Great, thank you so much. Natalie, maybe turning to you, I guess this is sort of partly sort of not trying to get you to sort of share operational secrets in terms of how you're planning for 2023, but any sort of broad strokes thoughts that you have on that question in terms of what companies can be doing to sort of improve their chances of investment.
Yeah, I think it's a great question. I was actually taking some notes because, being on the other side, it's something that we're challenged with as well. Internally, what we discuss is how can we best present what we see and what the team sees is really a really big opportunity, and we're kind of eager to go after it. And so certainly having all of the financial statements ready, having a robust data room, all of those things we've been working on to be able to to show, the fundamentals of the company. And then the rest is really how can we find the right way to communicate who we are as a company, our mission, and then the opportunity that's ahead. I'm not sure if I'm answering the question in terms of advice for other startups, but I think as with anything, preparation is key. So to the extent that we can have our documents in order, and then it's really a question of communication and finding the right fit with the right investors.
Great, fabulous. Thanks so
Could
much
I
for
add
sharing.
something?
Oh,
Sorry.
of course, go, Salome, of course.
Yeah. So Natalie, as you were speaking, I just remembered as a startup or a fairly young stage company, you don't have everything, all your ducks in a row necessarily, but it's also really good to point out, let's say your corporate governance is what is lacking. Like already saying what needs to be improved on, and you'll be surprised that there could be TA in any particular fund that now understands how to target that, therefore not necessarily disqualifying you. So also showing the things that need to improve is something that works in your favor.
Yeah, that's great. I think that self-awareness is so important. One of the learnings I can share from the experiences in the seed round is that we were not really very aware of the different TA opportunities that would come post-investment. And I can say that since securing the investment from the seed round, we've really benefited from some of those instruments to help us structure the company for further growth. So right now we're benefiting from a project that is helping us build a best-in-class finance organization. We received some support from Manufacturing Africa that was really helping us to prepare for the Series A fundraising, and we did a market assessment that helped us really dig into the market opportunity in sub-Saharan Africa at the country level for Coolbox specifically. And so those maybe are not the question for today around debt and equity and alternative sources of financing, but I can say that they've been invaluable at our stage and as we're trying to build and grow the company.
Fantastic, great to hear that you're able to draw down on that kind of resource. Fabulous. Maybe then to you, Roland, to round up in terms of this question, in terms of sort of where you see these opportunities for for improvements on the company side that can really try and help meet investors and help them to invest in our space.
Yeah, I mean, I think I have little to add to what has been said. Things that we are doing actively is, for example, again, coming back to my standardization story, seemed like a broken record, but like if you're dealing with a green light planet, then it's not their first time raising debt or equity. They know the drill. If you're dealing with companies that haven't done so before or have in only very little amounts, you're dealing with a lot of work from an investor side to get them to that investment readiness. So the way standardization works in this is, for example, we have a standardized financial model. We created that and we asked the company to fill it in. So they fill in assumptions, so they don't need to make the model. And that's just a very small example of how efficient standardization can be, because that means that we can, at our end, compare all the different elements apples to apples. And from the company perspective, there is no need for putting a lot of time into making a very decent investor-ready financial model, nor do we need to audit the model, spend time on that, right? Just very simple things. And these baby steps all together build up towards a more easily investable environment.
Fabulous. Great. I love that double plug for standardization there at the end. I don't see any more questions coming through. It's not that it's just my slightly clunky laptop, Lara. There's nothing coming through on your screen, right? That I'm ignoring everyone who's clamoring at the bit to ask some questions. No.
No, nothing else on this side, no.
Well, in that case, I'll just take a few minutes or moments to say thank you so much to everyone who shared. As you presented, exciting to see these really big jump in terms of the investment into our space, but still a lot of challenges, a lot of opportunities, such as those we've talked about at the end of this session, in terms of how we can actually sort of bridge that gap between the investment we need to reach the access levels that are so keenly needed. And so, yeah, just a big thank you to Salom, Natalie, Roland, and Laura for sharing all of the insights today. And thank you to everyone who has joined the webinar to listen into these, and hopefully see some of you at USCA. Take care, everybody.
Thank you. Have a good one.
Thank you.
Thank you.